In late Q1 2026, a severe geopolitical shock hit the Strait of Hormuz, threatening 20% of world oil supply and triggering a 40% surge in crude prices. Under textbook macroeconomic theory, an acute energy crisis and rising inflation fears trigger immediate capital flight into the ultimate safe haven asset, physical gold. This split-screen chart illustrates the anomaly. On the left, Brent crude spikes. On the right, the XAUUSD, the spot price of gold measured in US dollars, plummeted 18.5% from its record high of $5,589 an ounce on January 28th. During this localized panic, gold suffered its single worst trading day since the 1980s. The spot price functioned as a mechanical barometer for US dollar liquidity, overriding its traditional role as a gauge of geopolitical fear. To understand why textbook models broke down, we have to look past the top-line price drop. This sell-off was driven by a collision of three independent variables: political, logistical, and mechanical. Variable 1 was political. A sudden transition in Federal Reserve leadership shifted market expectations for interest rates. Variable 2 was logistical. The Middle Eastern conflict generated a massive energy inflation impulse across global supply chains. Variable 3 was mechanical. A massive expiration cycle hit the derivatives market, forcing the settlement of $5.7 trillion in financial contracts. The synthesis of these three forces created a highly specific macroeconomic transmission mechanism. We call it the real yield trap. Before the paper market collapsed, the structural demand for physical gold was at its highest point in decades. The People's Bank of China had just recorded its 15th consecutive month of gold accumulation, pushing sovereign holdings to 2,308 tons. At the same time, global physical gold ETFs, exchange-traded funds that hold actual bullion on behalf of investors, hit a record $333 billion in assets under management. These massive physical inflows occurred at the exact same moment the spot price was collapsing on trading screens. The crash remained a liquidity-driven event isolated to paper instruments, occurring even as physical demand foundations remained robust. The catalyst for this paper sell-off arrived on January 30th with the nomination of Kevin Warsh as chairman. This triggered the Warsh shock. Markets immediately priced in his hawkish reputation, anticipating a policy built around AI-driven disinflation and higher-for-longer interest rates. This created what analysts call the stagflation paradox. An energy shock forced the central bank to maintain tight monetary policy, even as broader economic growth began to stall. The reality of this stance materialized on March 18th. The Fed held the federal funds rate at 3.5 to 3.75%, signaling only one rate cut for the entire year. Because gold pays no interest, this policy shift systematically increased the opportunity cost of holding non-yielding assets compared to cash or government bonds. To see exactly how this opportunity cost overrides safe haven demand, we have to examine the mathematics of the real yield trap. Real yield equals nominal yield minus expected inflation. When nominal rates stay high but inflation is capped, real yield turns sharply positive. Look at the dual axis chart below. As real yields rose, the US dollar index surged past its 100.50 resistance. Exactly then, gold collapsed. Capital looking for a safe harbor rotated into U.S. Treasuries, where investors could get risk-free yield backed by a strengthening dollar. Because gold is priced in dollars, that currency surge made the metals significantly more expensive for buyers using euros, yen, or yuan, which dampened global demand. In a high real yield environment, the mathematical gravity of the U.S. dollar simply overrides traditional safe haven sentiment. But macro theory only explains the trend. The sheer violence of the 18.5% drop was driven by market plumbing on March 20th, an event known as triple witching. Triple witching is a quarterly event where stock options, index options, and futures contracts all expire on the exact same day. On this specific Friday, $5.7 trillion in notional contracts were set to expire simultaneously. As the surging dollar put pressure on equity markets, institutional traders faced massive margin calls, demands from their brokers to deposit more cash immediately to cover their leveraged losses. To raise that cash, traders were forced to liquidate their most profitable and liquid positions, which included gold. Market makers then amplified the selling pressure through delta hedging, mechanically shorting the asset to balance their own option exposures. This is the anatomy of a flight to liquidity. In a severe margin crisis, institutions sell what is liquid to save the positions that are failing. The 18.5% drop functioned as an indiscriminate paper market flush, triggered by the specific mechanics of margin requirements and derivative expirations. This precise mechanical behavior has historical precedent. We saw the exact same cycle during the 2008 global financial crisis. In 2008, gold initially sold off violently as institutions scrambled for dollar liquidity, liquidating their in-the-money commodities trades to meet equity margin calls. The pattern repeated in the early days of the 2020 COVID shock. Gold dropped sharply as part of a broad asset liquidation before recovering once dollar funding stabilized. The data reveals a consistent rule. During moments of acute financial stress, gold behaves first as a source of funding and acts as a safe haven only after market liquidity stabilizes. Once mechanical forced selling concludes and policy interventions restore confidence, gold typically recovers its defensive status. This chart shows the erratic paper price action, crashing directly into a structural support band between $4,800 and $5,000, a zone defined by heavy central bank purchasing and physical accumulation. Despite the severity of the Q1 correction, major institutions haven't blinked. JP Morgan and Deutsche Bank are maintaining their year-end 2026 targets of $6,300 and $6,000 per ounce, respectively. These models assume that once the mechanical derivative flush is fully digested and the dollar's restrictive yield advantage inevitably peaks, capital will flow back into the physical asset. Until the Federal Reserve's restrictive regime breaks, gold's upside remains firmly capped by the physics of real yields, regardless of how high geopolitical tensions rise.